You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Buck has spent 14 years successfully making it happen. This is the Real Estate Investing for Cash Flow podcast. Now, here's Kevin Buck.
Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. And our guest for this week's show is a real estate and multifamily expert, Mark Hamilton. Now, prior to co-founding Hamilton Zans in 2001, Mark sponsored the acquisition, ownership, and development of nearly 40 properties in the Bay Area. Mark's main focus has always been locating value-add properties in changing urban neighborhoods and then reworking them into higher quality buildings with higher incomes, improved tenant profiles, and higher resale values. Now, Mark has considerable experience in partnership formations and operations, project planning and implementation, asset management and management oversight, landlord-tenant rent control issues, risk management, and zoning and building department matters. Now, before forming his own commercial brokerage and investment business back in 1994, Mark worked in the San Francisco office of Marcus & Millichap, subsequently co-founding Property Resource Group and Quantum Land Company. Now, here's what you're going to learn in our talk with Mark today. You're going to learn how Mark and his partner, Tony, met and what complementary skill sets they each brought to the table that has since created an incredibly successful multifamily investment firm. You're going to learn how Mark was able to get over his fear of investing outside of his local market, but more importantly, the scientific approach they took to supply and demand factors when identifying new markets to invest in. You can learn how their approach to investing has shifted from shorter-term investments, such as 3 to 5 year turns, to wealth-focused cash flow plays where they're holding in much more of an evergreen manner, meaning 10 plus years in length. You learn how they determine the appropriate timing of when to consider the sale of an asset versus recapitalizing and holding for another 10-year term. You're going to learn about the evolution from only accepting capital from high net worth individuals for their syndications to opening up their offerings to both family offices and institutional investors. You learn how they utilize organized investor social gatherings to build deep relationships with those who have invested in their deals. You learn who the most important key hires were back when they were entering into a major growth mode with their firm and what specific traits they looked for in those key hires. You learn how their firm is navigating rent control in states where they currently own assets. Additionally, you learn how they are assessing the risk of investing in new assets that might be in a rent control market, and much, much more. And so, guys, with that, I'm excited to get onto the show with Mark. But before we do, I have a few quick housekeeping items I'd like to run through. Like I do each and every week, I like to go through my one personal, one professional best. And so this week is actually a mixture of both a professional and a personal thing that is happening. It's actually happening this week. And so I thought that I would share it. I'm going to be speaking at the Best Ever Conference hosted by Joe Fairless this coming weekend in Keystone, Colorado. If you happen to be attending, please be sure to come by and say hello. I'd love the opportunity to meet you in person. And if you haven't purchased your tickets yet, you can save yourself 15% by using the promo code BUP15. Again, BUP, BUPP15. And guys, you really don't want to miss this event. I personally attended and have spoken at 2 of the 3 prior years' Best Ever conferences, and I can personally attest to this being a premier networking opportunity. Plus, we'll get to meet in person, and I'll even buy you a drink if you come by and say hello. So, in addition to speaking at this event, which I'm super excited about, I've also decided to kind of make it a dual purpose trip, and I've decided to fly my wife and my boys out to come join me so we can take advantage of Keystone Resort and hit the slopes together. Now, my boys are 3 and 6 years old, and so they're just getting started in the sport, and so there's not really a better family-friendly resort than Keystone, and needless to say, I'm super pumped for both the conference, but also creating some memories on the mountain with Joanna and the boys. And so moving on here, guys, if you love what we're doing here at the Real Estate Investing for Cash Flow podcast, please be sure to subscribe to the show and also take a moment to leave a rating and review on iTunes. It really helps us attract awesome guests to the show just like Mark. And so if you haven't done so already, please, it only takes a minute to do it. Go to iTunes, leave that rating and review, and I'll be sure to give you a shout out in the future episode. Lastly, here before we move on to the interview with Mark, just want to remind you of the free 30-minute phone call that I offer each and every week. I set aside 2 time slots where you can jump on the phone with me and talk about everything and anything your heart desires regarding real estate investing. Whether you're brand new or you're a seasoned pro, I love connecting connecting with other folks that share like-minded interests and have a passion for real estate investing. So you can go to my website, kevinbupp.com, get signed up for that phone call, and I promise you, I will not try to pitch you or sell you anything. This is just my way of connecting with other folks that, again, share a similar interest and passion for real estate investing. So again, kevinbupp.com to schedule that call. And now, guys, without further ado, I'd like to get on to the part of the show that you've been waiting for, which is our interview with Mark Hamilton. So here we go. Guys, it is my honor to introduce my guest for today's show, CEO and founder at Hamilton Zands, Mark Hamilton. Mark, how are you doing today?
I'm great, Kevin. Thank you for having me on the show.
Yeah, thanks for joining us here. Very much looking forward to our conversation here today. And what I love, Mark, for those folks that might not be familiar with you or your firm, Hamilton Zands, maybe give you a few minutes to introduce yourself, tell our listeners a little bit more about yourself, your background, and ultimately how you found yourself in this real estate world that we're living in here today.
Great, thank you. We are all in on multifamily housing. We started in the Bay Area, and for reasons that we may go into during our visit, eventually took on a step by step a bigger footplate, bigger geography, but it's all apartments, and it's always been apartments. Tony Zands and I started the organization in 2001. It was an interesting, almost chance meeting of two very complementary real estate diehards. And my wife and I had actually started our careers in this in the mid-'80s when we stumbled into renovating a very forlorn duplex in San Francisco that did two things. It made us fall in love and gave us our careers, and it was so rough it made my mother-in-law cry. But we held on for dear life, and Laurie and I worked at this for 16 years. Along the way, she really started focusing more on property management, and that left me open for business with whatever opportunity might walk in the door. And Tony Zands walked in the door, and his career was very complementary to mine, but also different. And that was a key game changer for me.
And what was that complementary nature that your partner brought to the table?
Well, Laurie and I and two other partners had been working at this little enterprise for more than 15 years. And it was all about finding properties that we thought could have a better day, that you might do better with some heavy lifting and blood, sweat, and tears. And we were pretty good at that. And it was a very all-in experience with properties that needed a lot of renovation. And that was good for almost with some ups and downs. That was good from 1985 through 1997, during which time we worked on a lot of what we would call smaller properties, anything from 2 to 12 units, generally older Victorian or Edwardian buildings, certainly in rent-controlled markets, which we might also talk about a little bit today. And by then, it just started to get harder and harder and harder to find things that we thought had promise, had upside. And so I started looking across the bay in Oakland and gradually started working on bigger buildings over there. And by 2001, I met Tony Zands. And so my career to that point in time had been very much about getting deep in the weeds, doing the heavy lifting, dealing with the building departments, city planning from time to time, elements of the rent control or the landlord-tenant apparatus, and just kind of going, an inch at a time, going hammer and tongs and really pushing through projects, and doing a lot of really in-person work with contractors, with management agents, with brokers, with tenants, with lawyers, with city officials. And Tony's experience, Tony was had an illustrious career on the institutional side of the business. He worked for Cushman Wakefield, went and got his MBA at the University of Wisconsin, which is the premier real estate MBA in the United States. And came back and went to work as a lender and JV partner at Northwest Mutual, which was a life insurance company that was very active in real estate in the Western U.S. at the time. And then went on to two other distinguished gigs, one at GE Capital and one at the Rosenberg Real Estate Equity Fund. And when he walked through my door, he was knee deep in two projects with his father that really cried out for somebody that could do the deep in the weeds work, that could do the up close heavy lifting that you have to do with value add properties in the Bay Area. And so one day he says to me, I want to be your partner. And I said, the best thing that could happen to you would be that I would say no, because you're going to give up a great career, a distinguished career, and get down in the weeds with me. Why would you want to do that? And he said, I have fatigue about all the work that I do, and all the travel and all the long days and long hours. And, as a rising executive, I've got a great career, but I don't get enough of the action. It was still passing him by. And he said, I really want to do something that's going to put me in a position where I can participate in the action more. And I said, well, I think you're making a huge mistake, but I got no problems, because if it doesn't work out, I'm going to keep doing what I do. And a great match was born. And he brought a lot of institutional rigor, certainly financial and financing acumen and underwriting acumen. But he also brought one other thing that was probably the biggest difference maker, and that was the willingness to view real estate after getting off an airplane. And I had never done that. I was very constrained to what I could drive to, and didn't have any real feeling for how I was going to be able to tell the investment story to my own investors if the property was 1,000 miles away. And so that had always been an impediment for me. And it was as natural as getting out of bed for him. It was not an element at all. And shortly after we became partners, the Bay Area just continued to get pricier and pricier and pricier. And when we say that in this industry, as you know, we're talking about returns. Returns just kept getting compressed and opportunity harder to find. And so by 2002, we were investing probably in our second year. We were certainly by our second or third year, we were investing in Washington State and selling high valued but smaller Bay Area properties and doing tax deferred exchanges to properties that in many cases were recent vintage, but comparably more affordable than the Bay Area, and that were going to be cash flow generating. And so, we did that, and, by the early 2000s, we were doing that. And I'm sure you've seen this, where, when you get into a marketplace that's good, you're not going to have that marketplace to yourself very long. And historically, what we've done and what I did before is you just work your network as hard as you can to find all the opportunity that you can. And then when the opportunities aren't coming, you need to start looking for other places, and then you reset and do it all over again. And curiously, our first out of market metro was Spokane, Washington, of all places. But we ended up doing 7 transactions there, and the same thing happened. Values there started rising, returns got more compressed, and then we went to Thurston County, Washington, which is Olympia, and Lacey, Washington, which is a great marketplace in the Puget Sound, and just worked that as hard as we could. And by then, our third partner, Kurt Houtkooper, was in the shop, and he had a real expertise and a real nose for diving into markets and finding deals. And in no time at all, we were just in management mode in Washington State and looking at other markets. And I think the first 2 markets that he took us to were Colorado Springs and Las Vegas. And along the way, again, as the story gets out and as values rise and opportunity becomes harder to find, we migrated to a number of other markets. And so along the way, we picked up Oregon, as I mentioned, Nevada, Arizona, New Mexico, Colorado, Utah, Texas, Idaho, and in the last few years we've gotten into the Midwest and into the Eastern time zone. But every time it's been precipitated by ongoing need to make investments and increased difficulty in finding them in marketplaces that we've established. And so every year we spend time looking at places that might be the next market. And in the last couple of years, we've picked up both the Kansas and Missouri sides of Kansas City. We are in the process of acquiring our second asset in St. Louis. We've picked up, we're buying our fifth asset in Atlanta. We've picked up about 8 assets in Virginia. I think we're working on transactions number 5 and 6 in Nashville. And we've also picked up properties in Maryland and in Connecticut, of all places. And, we never set out to have a nationwide footplate, but along the way, we've had the great good fortune to make good acquisitions, that we're going to be able to produce the returns that we need to get for ourselves and for our investors. And we've had the tremendous good fortune to have great people in our organization and work with a lot of terrific people in the industry, as I'm sure you do.
No, absolutely. There's a lot to dissect there, Mark. So I'm going to try to break it down because I've got a lot of questions that just came out of the last 5 minutes. One of the big ones would be when you guys are in any given market and you start seeing it be a little bit more competitive, cap rates get compressed, returns diminished. What criteria are you looking for? What are you seeking in these other markets that would ultimately have you say yay or nay to going into one of these other respective markets? You mentioned many different ones that you're in, but what were the main economic or investment drivers behind those given markets that drew you there?
That's a great question, and I should say too that one of the other disciplines that Tony brought when he walked in the door is a real studied approach and vigilance about supply and demand. And obviously, if you're going to get an MBA, you better walk away with an awareness of supply and demand, or you've been fishing for 2 years. So I think our core temperaments and sensibilities were formed by the Bay Area, which is a place that we all know it as a high cost area and as a place where there's seemingly limitless upward pressure on the cost of housing. But the flip side of that coin is driven by the jobs. The jobs here are, obviously technology, entertainment, biotech, finance, and it's a port area. So there's really strong there's a really strong jobs economy here, and it really in any place, real estate is a relatively inelastic commodity. I'm not going to say it's a fixed commodity, but over long periods of time, the supply is going to grow at a certain pace, and very frequently the demand will grow more rapidly. And importantly, as industries evolve, the purchasing power of any given household rises, and that's when you get a housing crisis. That's when you get real affordability problems, because you have higher wage people in a given market. And so aside from supply and demand, we always look for that qualified household income, and in places that appear to be on a sustained arc of having not only strong jobs formation and relatively measured supply delivery, but also rising household income. And other than that, we, back in the day when I started, I certainly didn't have those disciplines. I was an English lit major, and who dove into this because it seemed like the right thing at the time. But I was just looking for things that were very clearly undervalued. And in San Francisco in the 1980s, there were significant parts of town that were fairly rugged. And we worked those areas in kind of in only moderate proximity to the things that were the challenges in the neighborhood. We tried to stay a block or two away from difficult housing properties, from freeways, from these kind of things. And so, we were just looking for things that we saw enough information to tell that they were undervalued. And then we did our dead level best to guesstimate what it's going to cost to do the renovations. And so it was a value proposition. Is a dollar invested, or $10,000 invested, or $100,000 invested likely to be worth more than that same amount of money in this proposition? And historically, we've been really good at that. And I would say that as buyers, very often we tend to be our own biggest enemy, because we have, our vast majority of our investors are people we know, and or are related to. And so I call it the mother-in-law test. And it's like, if my mother-in-law is invested in this and, it's not going as it should, can I sit down and explain to my mother-in-law at the next holiday gathering why it is what it is? And so, that's another way of saying common sense. But, we look in the early going, we look for things that we could get hold of, do the work on, and sell in a relatively short period of time. But as values went up and returns went down, it became obvious that we needed to shift to more of an income model. And I would say that the years of doing just true short-term, heavy lifting, value add stuff that was intended to be short-term, that was the first half dozen years of my career. And then over the next 10 years, and including in the early years of Hamilton Zands, Tony and I made some really good choices and had properties that we were able to own for less time than we expected. But we went into them thinking that they were going to be longer term growth and income opportunities, but values and incomes were moving so fast that we were able to own them for fairly short amounts of time. And I can give you a little bit of information on that. By probably 2007, so over the first 6 years of our organization, the average duration of an ownership of one of our properties was 42 months. And since then, it's gotten longer, and it gets longer every year. We're more focused on income. We're focused on bedrock value and having good assets that we see a long horizon on. And our average hold at this point in time is probably between 6 and 7 years. But if you looked at the things we bought since 2009, the average hold is probably more like 8 or 9 years.
Very interesting.
Year it becomes more about income.
Yeah, so I'd love to talk about that shift because that's a pretty significant one, not just from a company based perspective, but also from an investor based perspective, because the investors that might have been used to shorter term, higher RRR type deals might be a slightly different target investor that's looking for a longer term hold, right? They don't need to hit the home run out of the park each and every time and get all their money back in 2 or 3 years or 4 years. In fact, they don't want it back. They say, Mark, please stop giving me all my money back. I need somewhere else to put it. Please just give me a very fair return on money, but keep it invested, please. I need the cash flow.
Well, it's really, you put your finger right on it. And, we've done some really extraordinary transactions over the years. We tend to model our acquisitions with enough severity that we last year, I think we took in probably 3,500 to 4,000 submissions. Of those, there was enough story to do a full underwriting on maybe 250 of them. In an ordinary year, and then we think we send out about 25 offers. So 4,000 to 250 to 25. And in an ordinary year, we'll get probably 80% of the stuff that we get really serious about. And last year we got 11. So it was a tough year. Last year, there was a lot of competition for assets. This year, we seem to be a little more ahead of the game. But you're right that people do want that duration. And by the time Tony and I met, he probably had, among his close friends and family, he probably had a dozen investors. and I probably had 24 investors. So our investor pool at that point in time was, maybe 30 to 40 people. And they'd been around us long enough to know that what we were looking for was value add with income. And so if we sold it in 3 or 5 years and produced, a nice gain, that was in line with what people wanted. But we have approximately 85 apartment communities, and these are mostly family, but we have investors who could be in half to 95% of the partnerships. And we literally have investors and their family who are in 70 to 80 of our partnerships. Mm-hmm. And that is what they want. They want continuity. And, so our shop has evolved in our business and our industry, and meaning your industry and mine, has mm-hmm. evolved to a place where getting those short-term home runs is not, you can't really build a business model on that. It's hard to find enough of that to run the staff that you're going to need to capitalize on those assets. And we do have people that I have people that have been in partnerships with me since 1991 that are still in partnerships in this organization. I probably have a half a dozen to 8 partnerships that are still going that preceded Tony, and Tony's got a couple here as well that were earlier. But it is what people want. It's like, gee, it's great that you made a meaningful profit once again. But that means that while you're in an exchange, right? While the money's in an exchange account, and while we're getting started on the next asset, that means my distribution's going to be high. And people really, our clients are, they look like me. I'm 61 years old, and that's probably maybe almost average for our investor base. And that is what people want. They want the continuity. They want to know that they're getting good assets, that they're things that we have our own money in, and that we're doing the daily work on. And they want to know that it's got a promising future, but they are probably past the point of having to justify their own investment with the idea of making a sudden gain. They really want continuity.
You're speaking to that over the past 5 years. How have you had to adjust your investors' expectations as far as returns are concerned, based on the rising cost of assets in any one of the given markets that you're currently invested in?
That's a great question. In 2009, and in the few years that followed that, we saw daylight in assets that were just not getting any love. And in 2009, the tide was out pretty hard, as I'm sure you recall. Mm-hmm. And so returns went way up because people just weren't buying, and in some cases people didn't have capital. And we have an investor base that we stay in constant touch with. In the last 16 years, in the last 18 years, there's never been a year where we haven't done acquisitions. We've done as few as 4 acquisitions and as many as probably 15 or 16. And in my entire career, going back to 1985, there were only 2 years where I didn't do acquisitions. And so, from time to time, you'll based on market conditions, you may see years where it's just really hard to do deals. And we're going to be market responsive first and look for returns. We're not in business to just do deals. We're in deals. Yes. We're in business to do the things they're gonna work. And as you point out, it's more difficult every year. And so in 2009, we bought 4 properties, and they were all from purchases from a REIT that had some bond redemptions that they had to meet, and so they had to raise capital, and people just weren't buying. And so we got phenomenal pricing on 4 assets, 3 of which we still have. One of them we sold and made significant multiple for the investors, and then went on and did another trade. And on the other 3, we have since refinanced and returned all the capital, and are generating large cash flows, and could probably sell any of them for significant multiples against the original equity. But those cap rates at the time were probably 8%. Financing was probably straddling 5%. So you had a good spread there to start with. And there just wasn't competition. And then every year, as the market returned to health, and certainly as interest rates continued to decline, pricing went up. And along the way, incomes, property level incomes generally went up as well. And so we were probably, we wanted to make 9% rolling out of bed in 2009 and 2010. And we were able to find some opportunities to do that. And every year, the year one cash flow anticipation went down. And right now we're working really hard to make a 5% distribution, and are really just not likely to do it if it's not going to be at least 5. If there's some other aspect to the story that the asset is mispriced because it's got a financing burden on it that's with a rate above market, we might be able to go a little below 5. But really, we're looking for those assets right now that are going to have at least a strong 5 to 5.5, with some 18 to 24 month upside to 6, and a 5-year upside to maybe 7. And clearly, you're forecasting some rent growth. We tend to be very modest about our projections for rent growth, and we tend to be pretty pessimistic about expense growth, because expense growth will always find you, and you can't hide from it. The other thing that we do, that I take a lot of pride in, is we always assume the market's going to be worse than it is when it comes time that we might sell the property. So we're not banking on cap rate compression to carry our business thesis. But along the way, as I mentioned earlier, we have partnerships that go back almost 30 years. And from time to time, even though people like the stability of the cash flow from an asset that they know, we've also concentrated every year on bigger properties, on somewhat better located properties, on newer properties that have better amenities. And so while we know the investors may not love it, if we sell an asset, if we see something that's really kind of reached its summit because of age and type and location, and in our judgment, it's at its best day, we're gonna sell that. We're gonna do a tax deferred exchange. And because of we have properties from time to time that'll distribute as much as 10 or 12%. And needless to say, investors like cash flow. And so if we're going to sell that, there'll be some long faces about, why are you selling, something that's distributing 10 or 12 to get to a 5 or a 6? And we'll tell the story, age, some degree of potential obsolescence, unit type, location versus what we can buy. And if we remind them, because they may have put $100,000 in and they may come out with $250,000. Well, 5 or 6% on $250,000 is going to look a lot like 10 or 12% on $100,000. And then we reboot to an asset that we think will serve a longer agenda, and will also have expense growth. But now, returns have gotten compressed, and I think for us, the fact that we have so many legacy partnerships, on any given property, we might have 2 or 3 partnerships that are invested in it, and we probably have somewhere between 175 and 200 partnerships. And so, because those partnerships have been around for a long time, and because our arc has been, in my career, as small as 2 units and as many as 600 units. And the average size of our individual properties gets bigger every year. We look to things that are either very clearly on their best day, or that don't fit the forward-going strategy of newer, bigger, better located, higher incomes. And so we will always have, and we're generally a 10-year fixed rate borrower. And every year we're going to have loan maturities. So every year we have the responsibility, but also the opportunity to look at the assets that are going to have capital events, and evaluate whether or not we are better off refinancing them and keeping them and returning some capital, or selling them and reinvesting and starting over again. And so every year is quilted together out of that kind of mix.
Got it. Got it. No, I appreciate you sharing that, Mark. And I'd love to talk about, something that I feel is a part of the typical growth trajectory of a company that went, from where you guys started in 2001, which based on your website, I think it mentioned 16 units in 2001 to nearly 20,000 units
Yeah.
today that you have under ownership management. And that one pivotal moment is going from only accepting high net worth accredited investors to accepting those high net worth accredited investors, but also bringing institutional capital into the mix.
Yes.
I know that, and based
Yes.
on your website, it looks like that you do utilize institutional capital. You built some of those
Yes.
relationships. Can you talk about that moment in time where you were open-minded to that conversation and how that
Sure.
ultimately played out?
Sure. Absolutely. And so when Tony and I joined forces, I probably had in my own little portfolio, which I think was 17 properties, I think I had probably somewhere around 250 to 300 units. And Tony had two 30-ish unit properties also in Oakland, where I was very heavily invested at the time. So we probably started out with between 300 to 350 units. And the first acquisition we did was 16 units. And it was right on the heels of 9/11. I mean, he had quit this job and shifted a career path from a really outstanding corporate real estate career path. And here comes 9/11, and here he is sitting in this tiny little office with me. But we kept our nose to the grindstone, and we're always very mindful about returns, and that is to say, not only the returns we're looking for when we're buying assets, but also the returns that we're getting on the portfolio that we have, such as it may be. And at that point in time, it was a smaller, much smaller Bay Area portfolio comprised of 15 to 20 properties that probably averaged 15 to 20 units in primarily Oakland at that point in time. And we just stayed true to our core ideology, which is making good decisions about returns and looking at what we have and looking at what the market would bear. And so in the next few years, we started buying bigger properties in the East Bay, but also started selling them and buying bigger properties in Spokane, Washington, of all places. And I remember a moment in 2004 where we had a gut check because we had an opportunity to buy a small portfolio of 4 properties in East Oakland, across the street from a hospital, that was about 70 units. And we also had an opportunity to buy approximately 100 units in the Olympia, Washington area. And we just looked at each other and said, do we have the nerve to do this? Are we gonna be able to raise the money to do this? And we were pretty sure we could do it. So we just, we bit down and went ahead and did it. And it was a number of years before we started doing material business with institutional partners. But this is a people-driven business, as I'm sure you know. And part of that is working with not only brokers and the like, but also counterparties, which might be other buyers or sellers, or might be other investors. And people put the word out, and when the story's good, people will be open-minded. And so we got courted a little bit by a group out of New York that was aggregating money from other institutions, but also significantly from pension funds. And we did a property here in the Bay Area that may have been one of our last Bay Area executions that was really only modestly successful. But we went on and did, I want to say, 4 acquisitions with them, 5 acquisitions with them in Colorado, which was a market we were working on very hard. And along the way came the downturn, and a lot of really qualified investors were not hanging on to assets that they thought were going to be problematic. But we hung on to all of these, and all the investors earned some good returns. And then along the way, we started working with a number of other institutions, including major corporate organizations, structured capital arms of banks or financial institutions, life insurance companies, pension fund advisories. And I think all in, we've probably done probably 15% of our activity, and maybe 20% of our activity, some foreign money as well. Maybe 20% of our activity has been co-ventures with institutional partners. Usually we will, well, not usually, we always put our own money in the game, but usually we will also invite some friends and family into our little part of those ventures. And people have done really well with it. And it's curious that, we have great relations with institutional partners, but it's hard in the marketplace right now. It's very difficult to get the kind of returns that an institution needs, because, as you've mentioned, cap rates are really compressed. But we have a little bit of a carousel of equity solutions that we rely on. A lot of it's friends and family. We also work with some family offices and some high net worth individuals, and have ongoing relationships with probably 6 to 10 institutions. And we're just constantly looking for the opportunities and doing the best we can to match up the capital solutions that we have, and then seeing if there's a deal there.
Well, I think that's the important thing about performing and doing what you promised to do for your investors, and keeping that open line of communication, and treating everyone right. Because what ultimately occurs is that investor base, instead of going incredibly wide, it just goes incredibly deep. You make one investor happy, guess what they're doing? They're out on the golf course, or they're at church, or at a restaurant with their friends, and they're bragging about the great returns that Hamilton Zands is making for them on their money. And
well, you're right.
That's where a lot of it comes from, right?
It's a social thing. We're very social in our office. We make a point of spending a lot of time with the investors and having gatherings that are really just an opportunity to connect. They're not promotional, but sometimes they're 600 or 700 people there. People that know us, they know that we practice what we preach, and that that we're not doing deals just for the sake of doing deals.
A few other key questions I want to make sure that we get out. I know we're running out of time here, and I want to be respectful of your time. And we've been bouncing around a little bit from today to the beginning and everywhere in between. But during the first couple of years of your business, when you guys were in growth mode, you and Tony were looking to set the world on fire, and you were on your path to do that. What would you say were some of the key hires within your business? So you and Tony question. Sitting in a chop shop, together, looking at each other, saying,
question.
"What the hell are we doing?" But who were those folks you brought in that really helped propel your growth there?
Well, it's interesting to think about it that way, because in a way, we look for the same thing in people that we look for in assets. That it would just be, I mentioned earlier that anybody's basic premise is a dollar invested going to be worth more than a dollar. And I think we all look at people in a similar way, not necessarily monetarily, but is this relationship gonna pay great things? Is this going to be a great friendship for me? Is this going to be a great working relationship for me? And historically, we've hired younger people, a lot of younger people, and it's not based on ideology. That's just based on the reality of our network. And we've hired people who, many of our senior staff came in as interns or trainees or associates. One of our best people, our new CFO, came in as an intern. She was probably the most qualified intern in the history of the world. She had a CPA. She'd been at Price Waterhouse. She was getting her MBA at UC Davis and teaching accounting at the same time. But her father was a good friend and client of mine, and he asked if she could do an internship. And she came in and lit the world on fire. And as the years have gone by and our organization has grown, we are hiring more people who are perhaps not truly at the very beginning of their career, but might be in the earlier stages of their career. And then that's probably, now we'll sometimes hire people who are mid-career. But in our organization, Tony and I would both say that our number one hire was Kurt Howcooper. Kurt came in, he had a great real estate resume. a great animal for the business. Just really, wakes up thinking about it, goes to sleep thinking about it, and is just a total diehard. And he came in and really took over the acquisitions platform. And within a few years, it was just obvious that he needed to be a partner, and not through any insistence of his own, but it would have been a moral outrage if somebody like that doesn't get made into a partner in the organization that he's in. And so I just said to Tony, I think it's time. And he said, "You're right," and that was that. But we've also had really key people come in the asset management arena, and that was somebody who also came in as an intern. He now runs the investor relations wing. We had a colleague who came in the dark ages, 2008, 2009, 2010, where the industry was pretty scary. And he was a newly minted MBA from Wisconsin that great distinguished resume and credential, but the industry wasn't hiring. And I don't think he quite came in as an intern, but he came in lower to the ground. The guy that runs our acquisitions platform, our transaction platform, and who's been with us for 14 years, came in as an intern. And all these people have had really great career growth and made really great career contributions. And our experience has been that people who really just show the potential to be interested in the work and be in love with the work, and are going to be real contributors to the culture of the office. Those are the people we go for. And you could be the most massively credentialed person to walk in the door, but if we think that it's not promising for you to really give yourself over to the work and give yourself over to the team and the culture, then we're going to look at that and think it's probably not a fit. But it's people based.
Yeah, no, absolutely. And so just to reiterate, the very first one, I guess you could say director of acquisitions, who is now also a partner there, which is Kurt, right? So that was one of the big key hires to help propel the business. Asset manager is another position that you ultimately brought in that really helped you guys accelerate the growth of your business. And then what was the third one? What position was that individual hired?
Well, so asset management for a number of years was led by a fellow who was a young man when he started. He's still younger than I am, but it was a friend of my brother's. And he came in and worked his way up to the head of asset management and ran that for 7 years. And really working closely with Tony, really honed our asset management practice down to a real, fairly precise and well-organized unit. The fellow who had been running our investor relations department at the time moved to Portland, and so the guy who was running asset management asked if he could take over investor relations, and he's done that now for a few years and been a terrific difference maker. But for us, it's transactional. Great people in the transactions team are going to be really important, and we have that. We have depth in our transactions team, which is not only buying and selling, but also refinancing in those cases where we do. Asset management is making sure that the collaboration with our regional teams and our collaboration with the residents at the properties is really humming as it should be to get consistent performance. And so you have transactions, asset management, investor relations, and then finance, bookkeeping, accounting. We call it in our organization, we call it finance, but it's inclusive of tax. Sure. It's inclusive of bookkeeping. It's inclusive of getting the distributions out, and we pay our distributions monthly to investors. So it's just really important that goes like clockwork. But I'd say those four pillars are the most important parts of our business. But a fifth one that's also very important and has been led by a managing director a fellow who's now a managing director, has been led for a very long time, is risk. And he also, he not only supervises insurance, claims, incident reports, and the like, he also He also runs the CapEx platform. At any given point in time, we might have between $50 and $100 million of capital projects going on our properties. And as it turns out, that's a friendly and useful pairing for him, because if we ever have a major property claim from a storm or a fire or one thing or another, that's going to turn into a project, and the project is going to be closely administered as an insurance claim at the same time. But I'd say those are the primary areas of our business.
Okay, fantastic. One other thing here I wanted to ask you before we move on to the end of the show here was about rent control, and I know that it's been a topic of discussion now in many different states. New York just very recently passed legislation to where there's now statewide rent control. We own properties in New York, so we have been impacted by that. I know that Oregon was the very first state to initiate statewide rent control. I do know that you own properties in Oregon, and I'm not sure any of the other states that you currently own, and if there's rent control that's currently on the books, or if there's talks of. But I guess really the question would be is how do you manage the risk of that, of rent control legislation being passed, whether it's there today or there's some reform taking place, or whether it's there's talks of it coming in the future? How do you manage that risk?
That's a great question. And it was certainly part of our decision ages ago to migrate to other areas. But I would say it's really just it's an element in an overall composite of a value proposition. I think that per se and by itself, rent control, as any of us might experience it, and certainly in San Francisco, Berkeley, Santa Monica, Oakland, and a number of other areas. I'm sure New York City, you have a really stout and administratively challenging rent control ordinance that you have to deal with. But rent control exists because of extreme demand and because of rising incomes in a given market that make it more difficult for, in some cases, people who've been there for a long time to get replacement housing. Generally speaking, their rent is going to be capped where they are. But in most instances, in California, we don't have vacancy control. So if somebody moves, that apartment is going to be available for the landlord to price as they see fit, and a resident moving out of a rent controlled apartment is arguably gonna have to meet the market again where they are. But we're not ideologues about it. We're mindful about it. We certainly, if we were going to seek investments in rent controlled markets, and we haven't bought apartments we haven't bought apartments in California in 15 years. But if we were going to seek apartments in rent controlled jurisdictions, we want to make sure that we can put together an investment thesis that makes sense. And generally, you'd be looking at newer properties. You'd be looking at properties that are more like what you and I would call core or core plus assets, and you'd have an anticipation of a fairly moderate mortgage burden, and you're arguably going to get modest returns as you go, and you're going to have modest growth, but you're going to have an asset that you might well own for 10 or 20 or 30 years, and get the benefit of gains over time. We are seeing more rent control. As we go along. I know that it's been a jump ball in Colorado over the years that has not gone through. I believe there's legislation on the books or coming in Virginia and Maryland, and again we're going to look at the ordinance. We do have properties in apartment communities in Oregon, and it's not at this point in time. Our experience is that it's not going to be debilitating because we don't tend to jackknife rents anyways. In our communities, people come in, they seek the property out because it's quality property at what they're going to esteem to be a good value, and the tenant gets the benefit of the bargain for 365 days. They're not in handcuffs. They don't have to live there forever. And after 365 days, we can reprice. And we generally, if rents have gone up, we generally reprice to get some increase. but also not so much that we're likely to precipitate a move out. The number one and the number one of two reasons for move outs in our portfolio are people leaving the area, changing. Well, I should say 1, 2, and 3 reasons are going to be a combination of people leaving the area, somebody having a job change, buying a house, that kind of thing. And we know this because we survey people on the way out, and very few people report that the impetus for their relocation was a rent increase.
Mm-hmm. Got it. No, that's great feedback. I appreciate that, Mark. And moving on here, you've been at this a number of years. You've been through many different iterations of your business as you guys have grown into a larger firm. If you could give yourself some advice, if you go back in time, knowing what you know today, and talk to Mark, I guess the first year that you were, just stepping foot into the real estate business, what advice would you give yourself?
Well, that's a great question. And I think ultimately you have to be choosy as an investor, and whether that's because you're going to be the sponsor of an investor or you're just going to be an investor in somebody's project. I think you have to be choosy. Real estate is an illiquid asset. When it turns over, more often than not, it's going to be because it's an opportunity to harvest upside. But it's an illiquid asset, just like owning a home. So I think you have to be choosy. I think you have to be patient. I think you have to be patient as an investor before making choices. But I also think you have to be patient and hardworking when you're an operator. And those are two things that I had at least an awareness of, and probably understood implicitly, even if I couldn't articulate it. But I think the other thing is you really just have to focus on the income, and you have to focus on your top line opportunity, which might be affected by rent control. And you have to focus on the likelihood that income might move and move up or down. If you're investing in apartments, you're probably investing in apartments in part because you believe that year on year with economic growth, you're going to have higher top line opportunity. If you're investing in net lease properties, you're not. You're just investing in the lease, and what will more often than not be it's simply a fixed return. But you have to focus on the top line. You have to focus on expenses and just be determined not to rationalize expenses. Because at the end of the day, there are really two things that have moved our industry, yours and mine, over the last 35 years, and that's increasing net income, which is what investors pay for when they buy an asset, and falling interest rates. And I just don't think you can forecast, you can build an investment thesis on a conviction that interest rates are going to go down. Turns out they did. They've gone. I've called that wrong. I've called that wrong.
Everyone has
for 35 years. But coming back to the mother-in-law test, I'd rather be able to tell my mother-in-law that I expected interest rates to go up, and have to explain to her that because they went down, we made more money.
Yeah, that's a good thing to be wrong about. Well, fantastic. Mark, this has been an absolute pleasure having you here on the show. Lots of golden nuggets that you've shared here throughout the hour that we've been talking. But what I'd like to ask you, if you just had one final golden nugget of advice or wisdom that you could leave with our listeners here today that may inspire and motivate them as they progress in their real estate investing career, what would that one last golden nugget be?
Embrace it. If you're thinking about going into real estate as a practitioner or an investor or a sponsor, you're not going to get anywhere with less than a full commitment to it. It demands your time. It demands your attention. It will always teach you new things. And if you show up for the assignment every day and you're doing work that you like and you really embrace it, and you get that it's not going to be like owning a mutual fund. You're not going to be able to follow it like you follow the stock market. You embrace it and pay attention to your daily, weekly, monthly numbers, and just pick it up and work on it every day. Then you've probably got a temperament that's suited to it. And if you make good choices, you've got a good chance.
Yeah. No, that's fantastic. Well, Mark, thank you so much for joining us here today. And, folks, if you'd like to learn more about Mark and his company, you can go visit him at hamiltonzands.com. And that's Hamilton and it's ZANZE.com, hamiltonzands.com. Mark, is that the best place to reach you? Or is there any other place where we can find more information about you and what you guys do? Is that it?
Well, the website is a great place, and we keep it current in terms of media postings and the like. And I'm quite certain that this will get posted there in the not too distant future. But you can also just look us up on the internet. We're in the papers, the regional papers from time to time because of our transaction activity. And if you're in the Bay Area and you want to stop in and say hello in person, please do. We have a great office in the Presidio of San Francisco. We get to look out at the Golden Gate Bridge, and there's a great staff of people here.
That's fantastic. Mark, thank you again. And guys, thank you for tuning into this week's show. And until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. You take care.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com, and we'll see you next Monday morning.